mantras, and then we're going to meditate, and then I'm going to study. Had a good sleep last night, trying to get to bed earlier. Was in bed by like 10:30 p.m. Pacific. Mm. I did a really cool reel about um, cortisol and dopamine by a subscriber that commented. So we're gonna meditate till about just after 7:15 a.m. Pacific, and then we're gonna study. Here we go. Let's do our affirmations. I've been noticing that this has been helping a lot. Just gotta make sure that my back's straight. Right? Seated straight up. There. Oh, that's better. We got lots of nice natural light coming in, so that's helping wake me up. Here we go. I'm gonna repeat this 5 times, this mantra. Hey, welcome, Orange Heart. Welcome. All right. I'm already the man who passed his mutual funds exam and stepped back into banking with confidence. I'm a full-time content creator and online personal trainer, earning $20,000 a month, doing work I love on my own terms. My knowledge, my presence, and my consistency attract everything I need. This is already done. I just have to catch up to it. I'm already the man who passed his mutual funds exam and stepped back into banking with confidence. I'm a full-time content creator and online personal trainer, earning $20,000 a month, doing work I love on my own terms. My knowledge, my presence, and my consistency attract everything I need. This is already done. I just have to catch up to it. I'm already the man who passed his mutual funds exam and stepped back into banking with confidence. I'm a full-time content creator and online personal trainer, earning $20,000 a month doing work I love on my own terms. My knowledge, my presence, and my consistency attract everything I need. This is already done. I just have to catch up to it. I'm already the man who passed his mutual funds exam and stepped back into banking with confidence. I'm a full-time content creator and online personal trainer, earning $20,000 a month doing work I love on my own terms. My knowledge, my presence, and my consistency attract everything I need. This is already done. I just have to catch up to it. I'm already the man who passed his mutual funds exam and stepped back into banking with confidence. I'm a full-time content creator and online personal trainer, earning $20,000 a month doing work I love on my own terms. My knowledge, my presence, and my consistency attract everything I need. This is already done. I just have to catch up to it. So again, if we're doing priming, I got one more mantra. Yo, what's going on, Orange Heart? Nana, welcome. Craig, welcome. Okay, we got one more mantra to do, and then we're gonna start the meditation. We got 30 minutes. I'm already the man who passed his mutual funds exam and stepped back in banking with confidence. I'm a full-time content creator and online personal trainer, earning $20,000 a month, doing work I love on my own terms. My knowledge, my presence, and my consistency attract everything I need. This is already done. I just have to catch up to it. Okay, we did our 5 affirmation mantras about the here and the now and what we want. Now, we've got our meditation. There we go. Boom. Yeah. So this is mindful. And then 30 minutes. Boom.
Welcome back. You can begin by taking a seat. You can pick your favorite chair or just sit cross-legged on a cushion. Let's take a moment to release any unwanted tension. You can do this by rolling out your neck in a circular motion.
My mask. And I got my coffee.
and giving your back a good stretch by twisting those shoulders left and right. Also, make sure to check for any tightness that might be hiding in your jaw or shoulders. And if you find any, just go ahead and release it, softening that area. Now that you're ready to settle in, find a starting position where you're sitting upright and alert, but without being too rigid. Your chest should be open and your shoulders relaxed. Go ahead and place your hands in a comfortable position. They can be folded in front of you or on your legs. Now close your eyes. Let's begin by taking a few slow, deep breaths, inhaling through the nose and out through the mouth. For each breath you take, notice how your chest and stomach rise and expand on inhale and how the body relaxes and softens on exhale. As you finish your next deep breath, allow yourself to return to your natural breathing rhythm in and out through the nose. Now bring your attention to where you most easily detect the breath. You might feel the air passing through the nostrils or touching the upper lip. Or sometimes you feel the breath in the movement of your chest or belly. Once you find that point, keep your focus and attention on it. This is your meditation practice, simply observing where each breath unfolds in this present moment. And remember, there is no need to change the breath, speeding it up or slowing it down. Just let it happen naturally, observing each part of the breath, the inhale, pause in between, and exhale. As you've been following the breath, you might notice some thoughts and distractions arise. That's completely normal. These moments shouldn't be discouraging because they are really an opportunity to strengthen your practice. Simply acknowledge the thought and then let it go, returning back to following the breath. And if your mind has wandered, no problem. Just slowly return to observing the breath. From this point forward, we'll use the sound of a chime as a reminder to bring your awareness back to the breath. When you hear it, if your mind has wandered, just slowly bring it back.
Welcome. Stay the full 30 minutes. Do it. We are halfway through. 14 minutes left. Mindset fam. Stay tuned. All right, let's finish our meditation. 2 more minutes. Hey, babe. Sounds good. Love you, babe. Yeah, well, yeah. Love you. Have a great day, babe.
And now, just take a moment to give your mind a break. No need to focus on your breath or think about anything at all. Just enjoy the mind at ease. And as the practice finishes, just slowly bring your attention back to the space around you. You can gently wiggle your fingers and toes. Now rolling out the shoulders and neck. And when you're ready, slowly open your eyes.
We good. We good, Hamza. Welcome, welcome. Welcome, Georgie. Or Georgia. Georgia Breaker. Welcome, welcome. All right. Meditation's done. I'll show you guys my current streak. Hang on. So we just did 30 minutes. We're in day 5, Mindset Fam. So we're going to do this every day, like I said. And now I got to get some studying done. Oh, that's it. Our bay window has been really helpful for helping to wake up bit early because we got that natural light coming in. So now we are going to get ready for work and study for the next hour. So it's going to be like this for the next little while until my course is done and I'm passed. I'll show you guys in just a minute here. All right. Gotta wash the face and all that. So, un momento, por favore. One sec. All right, mindset fam. Got my got my work gear on. Putting the iPad away. I'm gonna bring out the laptop to study. So stay tuned. But first, I gotta wash my face. Boom. Face mask back. Do our Let's do our moisturize. All right, mindset fan. Flip. Hang on. All right. I'm gonna do quick cleanse. Ready then. There. Cleanse. It's exactly 7:30, so we're gonna start a study block here. Got gel my hair. Gel. Good. Slide mindset fam. There. There. There we go. There. Okay. All right. We're gelled up, ready to go. Andy M. Panza, welcome to live. Thanks for tuning in. We finished our meditation. Now we're going to start studying. Then probably tomorrow morning I will do face mask. Might do some under eye pads. You're sick today? Oh, that sucks. Hey Andy, if you haven't already subscribed, hit that subscribe button. We're at 765 subscribers, and goal is to hit 1,000 in the next 30 to 60 days. With your guys' help, we'll be able to do that. So share this with someone else that wants to be motivated, inspired by content like working out, day in the life, studying, meal prep, etc. I can help. Oh, and one more thing. Just gonna quickly brush my teeth. There. I think this is pretty much gone. No more toothpaste. Mm. Mm-hmm. All right, I'm steady. There we go. Oh, you got a dog? Nice. Yes, we do. Hold on, I'll show you the dog. Boom. Okay. Boom. Pop. Hang on, hang on. Hang on, hang on. Hang on. Oh, oh crap. Forgot it's had a charger on it. Hey there, Pop. C'est bon, c'est bon. All right, we're steadying right here with some binaural beats. Here, here's Jog's a German Shepherd. Pino is a little cockapoo. Pino. Oh, sleepy, sleepy boy. C'est bon, c'est bon. Okay. All right, we're gonna do some reading there, Mindset Fam. Our chapter reading. And then there, bringing this a little bit closer. Boom. And I'll show you guys. Oh, all right. So now let's say study with me. Boom. There we go. Oh, boom. All right. That's cool that your dog's a German Shepherd. All right, here we go. There we go. There we go. Boom. Oh dear. Okay. I just got to figure out when. Figure out where I'm at with my reading. So let me find it. 12:19. 12:19. Okay, I found it. Mindset fam. Found it. $12.19. Doing that here from. Whoop. There. Okay. Found where we're at. All right, here we go. Boom. We should be able to get a good chunk of the next chapter done here. Hang on, put that over there. There we go. That's better. Here we go. Okay. We're almost on chapter 13. Yeah. 13, 14, 15, 13. Yeah. Alternative managed products. We're just finishing riskier mutual fund products and then alternative mutual fund products. Okay. We're on 12-19. We're so close to the end of that chapter. Oh, here we are. All right, I'm popping on some binaural beats. Bingo. This is what I listen to when I do my reading. Check it. Binaural beats, royalty free. Hey, sorry, I had to take a shower, so I left. What is happening here? We're doing some studying now from a mutual funds course. So here's my course text, and I'm going to read it aloud to all of you. So doing that right now. We're on chapter 13. Sorry, almost on chapter 13. We're on chapter 12, riskier mutual fund products, and then we're going to be on reading some of chapter 13 as well. So sit back, relax, and enjoy this study session with me. Binaural beats is on. Let's do this. Okay. Crystal Resource Fund. The investment objective of the Crystal Resource Fund is to provide capital growth by investing primarily in stocks of Canadian natural resource companies. This fund invests in stocks of companies primarily engaged in the precious metals, base metals, oil and gas, and forest products sectors. Yeah. Um, which have high growth potential. The fund may invest in small cap companies and purchase and sell commodities such as precious and other metals and minerals. The prospectus has the following to say about risks. Because it invests in only a few sectors of the economy, the value of the fund may vary more than funds that invest in many different industries. Its value is also affected by movements in commodity prices and changes in global economic conditions. Because it may invest in smaller companies, the value of the fund may vary more than funds that invest in only larger established corporations. As is the case with many specialty mutual funds, the goal is to earn capital gains. It is notable that this specialty mutual fund invests in the types of firms, industries, and securities that other types of specialty mutual funds invest in. The prospectus states, for example, that this fund may buy securities of small capitalization firms. Specialty small cap mutual funds do exist, and there are also mutual funds that specialize in only one commodity, gold. In a sense, the Crystal Resource Fund is more diversified than some other specialty mutual funds. The 35,289,000 investment portfolio presented in Figure 12.8 indicates the following partial breakdown by investment area. Oil and gas, 22.6%, 7,991,000. Gold and precious metals, 14 million, so that's 40% of the portfolio, 40.2%, 14,169,000. Paper and forest products, 6%, 2,104,000. Industrial products, 4.1%, 1,430,000. Metal and minerals, 6,904,000. That's 19.6% of the portfolio. And money market securities, 7.6%, 2,691,000. And that's the breakdown of the 35 million portfolio. These securities are held for liquidity purposes, either to meet redemption demand or to take advantage of perceived market opportunities. So here's the diversification of this resource mutual fund. Shows you total portfolio, 35 million, and then it shows you the percentage of how it's invested in. And this is all commodities, all precious metal mutual fund. And then it shows you the pie chart of how it's broken down. We're almost done this chapter. We were so close to being done the last time we did our reading. Crystal Precious Metals Fund. According to the investment objectives of the Crystal Precious Metals Fund, this fund seeks to provide long-term capital growth by investing primarily in precious metals, gold, silver, and platinum, in the form of bullion, coins, receipts, and certificates, and in common shares and other securities of Canadian and foreign companies involved in directly or indirectly in the exploration, mining, and production of these metals. Yeah, totally. It breaks it down really well. The fund will not purchase silver and platinum in excess of 20% of its net asset value. The fund may from time to time have a large portion of its assets in cash or cash equivalents in response to changing market conditions. Because the fund invests in a specialized sector, it is particularly sensitive to changes in that sector. The price of gold and other precious metals can swing dramatically because of international monetary policy, political events, and speculation. In addition, the price of gold may be affected by political conditions in South Africa, which remains the world's largest producer. Changes in the sector will affect the value of the precious metals held by the fund, as well as the value of the companies in which the fund is invested. Much of this, but I will be here. Appreciate you. Appreciate you. Yeah. The price of precious metals is quoted in US dollars, so the unit value of the fund will be affected by changes in the value of the US dollar relative to the Canadian dollar. The fund is more specialized in the resource fund described above, since it invests only in precious metal sector. Because the other one was precious metals and forestry and yeah, paper and industrial products and oil and gas. This is just precious metals. According to its annual report, 58% of the fund's assets, shown below, consist of common shares of Canadian firms engaged in gold and precious metals mining activities. 118,040,000. The fund also holds gold and gold and silver certificates, 43 million, 21% of the portfolio, and shares of foreign metal and mining firms worth 35 million, 17%. So Canadian common shares of Canadian firms, 58% of the portfolio, gold and silver, 21%, shares of foreign metal and mining firms, 17%. Crystal Special Growth Fund. We've just got one more. Oh my God. Hang on. Yeah, there we go. Here we go. Now there's just one more. So Crystal Special Growth Fund. The simplified prospectus of the Crystal Special Growth Fund describes the objectives, investment policy, and additional risk factors as follows. The objective is to generate long-term capital appreciation by directing investments into areas of emerging trends and values. Investment strategy. To achieve this goal or this objective, the fund invests primarily in smaller companies. The emphasis is on analyzing and picking individual stocks rather than industry sectors. The fund invests in smaller companies, generally lower than 500 million in market capitalization. Capitalization is just the overall value of the company on any given day on the stock market, how much it's worth. The securities of smaller companies are often less liquid, less marketable, and more volatile than those of larger companies. It is possible to think of this fund as simply as an equity mutual fund, except that it specializes in small capitalization or small cap firms. These are typically firms making and marketing new types of products for which market demand may be difficult to determine. In addition, many small cap firms can be bought only on OTC market, over the counter market, and may trade infrequently. This makes the market for shares in these firms less efficient. Yeah, yeah. Small companies have less liquidity. Yeah, less cash reserves. In the investment portfolio shown below, Canadian equities account for 84% of the specialized growth portfolio. So industrial products, 24%, consumer products, 15%, communications and media, 14%, oil and gas, 11%, gold and precious metals, 5%, other industries, 13%. Wow, it's quite the mix. That's weird. Shouldn't they have more, or maybe they invest more? That's why they don't have. Yeah, they invest more, I think. So they're into the business. They have to invest more into the business because they have less cash reserves because it's more tied up into the business. That's why there's less liquidity. Yeah, more volatile. All right, fund wraps. A fund wrap program provides a series of portfolios with multiple mutual funds to reflect pre-selected asset allocation models. Each model is designed to meet the needs of a group of investors sharing a similar client profile. In contrast to a balanced mutual fund, a fund wrap generally outsources the management and security section within each asset category to different managers. Responsibility for the asset allocation decision falls to the wrap sponsor. For convenience, all administrative management and trading costs are usually rolled into one wrap fee. Fund wrap investors hold the unitized value of the fund of funds. but they do not hold title to the underlying funds or to the fund's underlying securities. Fund wraps are available with advisor compensation either built in or excluded, fee-based approach, increasing the flexibility and acceptability of these products. From a trading point of view, there is no substantial difference between fund wraps and traditional mutual funds. From the client's point of view, the purchase, redemption, and reporting process is the same as for mutual funds. From the mutual fund salesperson's point of view, the process also is largely the same, with differences only in details of compensation. From a regulatory point of view, fund wraps constitute a specific investment structure. Fund of funds exists as a legal entity in addition to the legal existence for the underlying funds, mutual funds. Thus, specific regulatory provisions govern the development and promotion of fund wraps. Regulations include, for example, prohibitions against double dipping, charging fees twice for the same service or components. Otherwise, trading fund wraps as units is essentially the same as trading fund units. Oh, trading fund wraps as units is essentially the same as trading fund units. The fund wraps can be funds of funds or portfolio allocation services. With funds of funds, the client owns units of a pool of mutual funds, while in a portfolio allocation service, the client owns units of several mutual funds in the proportions established through the allocation service. Thus, in a portfolio allocation service, the investor actually owns units of the constituent mutual funds rather than the units of a fund holding other funds. So they call that funds of funds. Double dipping is like when you charging fees twice for the same service. Nice. Okay. Chapter 13, Mindset Fam. Here we go. Boom. We got about another half an hour before we got to go back to work. So we're going to start chapter 13. I'm going to elevate this because I feel like I'm hunching down with my back. So let's probably go and set this up on the bistro table. Oh, man. We were up early this morning, Mindset Fam, 6:30. Hang on. Let's put this. Follow me. Yeah, posture. Yeah, posture is bad. Yeah. No, posture needs to be good. Yeah, always like seat yourself like on a elevator or something like that. I do not want to have a hunchback. Okay. By the way, it's going to be yoga day today, mobility, cardio. Did 2 days back to back of kettlebell swings. So here we go. Alternative managed products. I'm just going to write my note in here. Boom. Boom. All right. What are, yeah, blah, 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 blah. Alternative managed products. So, can't remember how it goes again, but hang on. Just want to see. Yeah. So this section, nice. We only got a couple more sections for quizzes. So this one, this is the last chapter, and it's the longest section because it's four chapters, chapters 10 through to 13. Understanding mutual funds and managed products. So this is the section that so we've done chapter 10, 11, 12, and we're on this last chapter of this section. And then I can do the quiz. Boom. Here we go. All right, let's do this. I just want to see I just like to see how many pages are in each chapter. Looking ahead, there is 19. This is a Canadian securities course. So for Canadian, like all across Canada, getting mutual fund license to work in the bank to sell mutual funds. Beautiful. Okay, this is about 19 pages. So here we go. Introduction. Since the early 1990s, managed products have become popular investment vehicles for many investors, particularly those who consider direct investing in bonds or equities too complex or risky. These products are often appropriate for investors who have limited amount of money to invest but want the benefits of diversification and professional investment management. Managed products include more than just mutual funds. The one constant in the investment industry is change. Continual innovation in financial products, and the wealth management industry in general has resulted in an overwhelming number and variety of alternative managed products, which makes the process of making investment decisions all the more challenging. With more choice, investors have more homework to do before investing, and mutual fund representatives compete against new products they are not licensed to sell. Alternative managed products are professionally managed portfolios of basic asset classes and/or commodities and include segregated funds, hedge funds, and alternative mutual funds, exchange traded funds, closed-end funds, and principal protected notes, PPN. What distinguishes alternative management products from other groups of investment products such as mutual funds is their use of complex investment strategies, such as use of derivatives, leveraging, and principal guarantees. The risk return profiles of alternative managed products when compared to conventional asset classes are skewed by the use of these investment strategies. This chapter looks at the features, advantages, and costs of the most common classes of alternative managed products. What are principal protected notes? Principal protected notes is a debt instrument like other debt instruments. Principal protected note has a maturity date upon which the issuer agrees to repay investors their principal. In addition to their principal protected notes provide interest paid either at maturity or as a regular payment linked to the positive performance of the underlying principal protected note asset. The underlying assets can be common stocks, indexes, mutual funds, exchange traded funds, commodities, or hedge funds. In Canada, PPNs are issued only by the six major banks, the big six. The banks function in three main roles: guarantor, manufacturer, and distributor. As the issuer of PPNs, the banks guarantee the return of principal at maturity. The value of the guarantee is based wholly on the perceived creditworthiness of the issuer. In the event of default, PPN investors rank equally with all other investors in the bank's deposit notes. What is the use of PPN here? Like, isn't this about mutual fund? It is about mutual funds, but sometimes they're going to be talking about bonds or guaranteed investment certificates. So the PPN, principal protected note, is like a GIC, guaranteed investment certificate, because the reason why they talk about these different things in this course is because inside the mutual fund, depending on how the fund's invested, it'll have GICs in it, notes in it, like principal protected notes, and stock, a combination of everything, depending on a client's risk tolerance. So that's why they explain each of these things that are inside the mutual fund so people understand. As manufacturers, they choose the underlying asset, the term to maturity, and any special features tied to interest payments. This role is almost always performed by a group that specializes in equity derivatives, which is typically part of the bank's capital markets division. It is, it gets complicated. Yeah. Honestly, myself, I invest in index funds. An index, it tracks the entire stock index of a Canadian index, a US index, and international. I keep it really simple. Passive investment approach. Passive means I'm not actively trading, I'm just buying at a regular intervals and I'm dollar cost averaging. So I'm doing $60 bi-weekly, $60 every 2 weeks, and buying fractional shares of my exchange traded funds, which are index funds. Makes it a lot simpler than doing all this stuff that they say. Cost of principal protected notes. Many costs are associated with principal protected notes. These products are not mutual funds. As a result, they are not held to the transparency standards of mutual funds or prospectus-based financial products. In fact, the lack of transparency in these products prevents investors from clearly understanding all the costs involved. It is particularly important then to determine their suitability before investing. Principal protected notes are not protected by the Canada Deposit Insurance Corporation, so they're not principal guaranteed. They are considered uninsured. That's what I was going to say. Yeah, they're principal guaranteed, but they're not insured. Their uninsured deposit notes are not issued under a prospectus because they are not considered securities. In most provinces, those who sell PPNs require no special licensing. All you said I understand, but this mutual funds course is super. It is. It does get complicated. Yeah. There are implicit as well as explicit costs to consider when purchasing a PPN. Explicit costs are described in the offering documents and include the costs identified in Table 13.1. Commissions, yeah. Common explicit costs, all the costs, yeah. Have been designed in many ways to resemble mutual funds. PPNs differ from mutual funds in that investors bear the cost of the commission at the time of purchase because the net asset value declines directly as a result of commissions paid. Management fees. Like mutual funds, many PPNs carry a management fee for actively managing the PPN assets. Some PPNs, however, are issued without management fees. When a management fee is charged, it is charged to the assets of the PPN. Management fees affect the PPN's performance, which in turn affects the final payoff received by investors. You don't need to understand it. Only if you're like looking to get into finance, this is just something you have to do. Um, in a Canadian bank, you have to. They require a mutual fund license because they require you to sell mutual funds to clients, and because clients will ask about portfolios and stuff like that, and you have to be um, licensed to be able to sell them. That's why. Early redemption fees. I am. I think you don't remember me. Mm, no, I definitely do. You were on the live yesterday, Nana. I think. Early redemption fees. Many PPNs carry an early redemption fee. A typical early redemption fee schedule runs from 2 to 5 years and declines over time. The purpose of the early redemption fee is to ensure that the PPN's issuer receives the full fees it was expecting. Structuring costs and guarantee fees includes an explicit charge for structuring, and most PPNs charge a fee for providing the capital guarantee. What? Oh, Nana. Yeah, 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 yeah. You were, yeah, yeah, yeah. I remember now because we were chatting about finance the other day and banking and you getting into international banking abroad. I remember now. Oh, hold on. Yeah, sorry. Sorry. It's an early morning. Mm. Appreciate you tuning in to the lives. And you tuned into the meditation. That's awesome. Okay. Structuring costs and guaranteeing fees include an explicit charge for structuring, and most PPNs charge a fee for providing the capital guarantee. Implicit costs include fees borne by investors that may or may not be immediately visible and that may or may not be openly disclosed in the documents. Identifies the more common implicit cost. So honestly, I'm gonna be straight up with you. I don't know about principal protected notes very much. They're similar to a guaranteed investment certificate. Turn on notifications. Oh, it's all good. Yeah, it is cool that it notifies you when I'm going live, which I like. That's awesome. And since you're a subscriber, I can you can check my posts section too, because you're inside the mindset community. So I do write in there if I'm going to be going live at a certain time or whatever. I try and stick to my times as best I can. Um, so stay tuned for any time I do a post as well. because you'll get notified about the live when I go live, and you'll get notified. Well, you won't. I don't know if you'll get notified about the post by being a subscriber. I don't know how that works, but I do write in my post section. Well, good you're tuning into this because you'll most likely have to do this once you get into banking there, Nina. Here we go. Common implicit costs attached to PPNs. Performance averaging formulas. Many mutual fund based and income producing PPNs use performance averaging formulas, in which the PPN final payoff is based not on the value of its underlying asset at maturity, but on the same average performance of the underlying asset over the life of the note. Yeah, I don't understand any of this either. The average performance typically is based on the note's monthly average net asset value and may raise or lower the return to investors. And I'm not going to lie, we don't do any of this in the bank. This is like more complex and very specific to certain clients. I will have to check time according to my country. Oh, yeah, totally. Because mine's in Pacific Standard Time, so I know it's a big difference from your local time. Performance participation caps. A PPM with a performance participation cap promises to pay the return earned by some particular asset up to a maximum amount. Example: an index-linked GIC might pay 60% of the return of the S&P TSX 60 index, while guaranteeing investment principal. If the performance of the underlying asset exceeds the cap, investors would incur an opportunity cost because they could have earned a higher return on the investment if the cap did not exist. Price return versus total returns. The final payoff is based on the underlying asset's price return rather than its total return. Total return refers to the change in price plus any income such as dividends or interest. Using price return rather than the total return is a hidden cost because it underestimates the actual performance of the underlying asset. All right, we're on 13-5, Mindset Fam. Boom. Chapter 13-5. And if I got enough gas in the tank to do another study session later, I will. You're bored, aren't you? Yeah, I'm definitely bored. This chapter is brutal. I like how they're starting with the stuff that's the most boring. And I'm half asleep reading it too, but that's all right. You're not always going to like the certain chapters that you read, but I have to know it. So, okay. Advantages and risks of principal protected notes. Individual investors with relatively small amounts to invest can use PPNs to invest in markets they normally could not access. PPN could use as its underlying asset a basket of selected commodities or a hedge fund. In this case, a PPN investor would not be subject to large investment minimums, accreditation requirements, or margin calls that would normally be associated with direct commodity or hedge fund investments. In addition, a PPN can enhance the return available from cash or cash equivalents, such as GICs or T-bills. See? Study for me is brutal. So you're good, at least you can sit to study. Absolutely. Just got to do it. It's a grind some days, but you got to do it. It's required. And it does get boring and it is repetitive and you have to do it. It just is what it is. Once you start studying, you'll know. Some sections you'll be like, oh my God. Today, with relatively low real interest rates, the nominal interest rate minus the expected rate of inflation on most traditional cash equivalents, a PPN can produce a higher yield while still protecting the principal invested. Finally, PPNs may also be appropriate for the extremely risk-averse investor. See, so there is a place for them. It's for people that do not like to risk at all, who has the ability but not the willingness to take equity-like risk. As long as the investor is convinced that the issuer's guarantee is secure, investing in a PPN can provide the investor with exposure to equities, commodities, and more without the risk of investing in them directly. While a PPN is free from risk of principal loss, it is not considered to be entirely risk-free. Risks associated with PPNs include liquidity risk, performance risk, credit risk and currency risk, described in table 13.3. Now it's talking about the risks. I see books and I also say, oh my God. Yeah, this text is 438 pages. And we're already on page 291 of 438. It's crazy. And I told my wife I'm not reading any other books until this is done. Because I can't, because it's so much freaking reading. She's reading her like novel in her Kindle, and then I'm reading this. Risks associated with PPNs, liquidity risk. So we got to leave already in 15 minutes, Mindset Fan. Most PPNs offer liquidity. They usually can be resold to the issuer before maturity at certain dates with associated costs and advance notice. However, the issuer is under no obligation to buy back the notes. Investors should buy PPNs with the intention of holding them until maturity. Yeah. So similar to a GIC, normally you lock it in 1 to 5 years. This is similar. um, that's why you have to chunk it out. I do half an hour to 45 minutes or 45 to 60-minute chunks, and then I take breaks. Otherwise, yeah, it's too much because it's a lot of technical info. Yeah. So performance risk. The performance of the PPM may not exactly track the performance of the underlying asset. It can either underperform or overperform it. Sorry, underperform or outperform it. The mismatch in performance is likely in the early years of the PPN issue. Investors are not just purchasing an underlying asset's returns with principal protection feature tacked on, because many factors are involved in pricing a PPN, including interest rates, fees, the actual performance of the underlying asset, whether leverage has been used, and various explicit and implicit fees. Credit risk. The issuer may not be able to return the principal at maturity. Although the likelihood is small, especially because the issuers are large, well-known banks, the risk is still there. Yeah, I hear you on that. Because many PPNs track the returns from a foreign underlying asset that may be dominated in a foreign currency, investors may be exposed to currency risk. A change in the value of the foreign currency relative to the Canadian dollar will reduce the returns when reconverted to Canadian dollars. Before investing in principal protected notes, PPNs are in some ways more difficult to evaluate than conventional investments. PPN issuers are not obligated to disclose as much information as they would if shares or a bond were bought to the market or brought to the market. Still, the following points should be considered when evaluating a PPN. The creditworthiness of the issuer should be without question. The issuer is the only party investors can turn to for payment or principal and return. The investor should understand the calculation method used to arrive at the final variable return. Investors should understand the risk factors behind the underlying asset, whether it is a mutual fund, a hedge fund, or a common stock. The principal protection should be worth paying for. This is especially important for longer term equity based PPNs over 5 years, where the maturity horizon lowers the risk of loss. The principal protection might be worth the cost for an underlying basket of commodities, but may not be worth the cost for an underlying mutual fund that has never lost money over the corresponding term of the PPN. Now it's a case study. I like when they do case studies because then they show like a client actually investing in this, because honestly, not many. So there's another thing that the bank sells, which to me is similar to a PPN, but it's still a GIC. It's called an index linked GIC. So your principal is still guaranteed. Let's say you invest 10,000, you're still getting your 10,000 after 1 to 5 years, but you get the upside if the market does well, you get the gains from the market. That's an index linked GIC. And it's a newer I guess it's a fairly newer product. I don't know how long the banks have been selling it, but I sold it as well when I was at the bank. And again, clients like it because it's a win-win-win. You maintain your principal is protected. You get guaranteed interest, and then you get additional interest on top of that guaranteed interest because you're getting um, the benefits of the upside of if the market does well. If the market doesn't do well, you're still getting that 2%. But if the market does really well, then you might get 5. Exactly. So you're still going to get a guaranteed rate of interest, even if the market does bad, 1.5, but you just won't get as much. Let's say the market does really well, you get 4.5%. And if the market does really bad, then you just get what yeah. So these principal protected notes are similar to that, but I'm going to dive deeper and see if the similarities are still similar. Okay, here's our case study. Probably going to do this case study, and then we're probably going to get ready to go soon, Mindset Fam. I got to let the dog out too. And I'm losing my voice. I need to hydrate. Case study. Paul balances risk and reward. Sandra is a mutual fund representative who works for the mutual fund arm of ABC Bank. She's meeting with her client, Paul. Having suffered heavy investment losses during the most recent financial crisis, Paul moved most of his investment portfolio into GICs and has been wary of reinvesting since then. However, Paul since seen equity markets rebound sharply over the last few years and knows that he requires growth in his portfolio to reach his retirement goals. Given how low present GIC rates are, Paul wants to discuss with Sandra investment opportunities that will allow him to benefit from the performance of equity markets without putting his principal at risk. Yeah. No, she's not mean. Paul, the client, is saying that he had heavy investment losses, and so he's not super interested in investing. He needs to grow. He needs to grow his portfolio, but he's just nervous, so he needs to be educated. Sandra explains to Paul that mutual funds are not guaranteed as to their principal or return, and that with the exception of money market funds, there is potential risk of negative returns in even the most conservative funds. However, Sandra suggests that if Paul wants to participate in the equity markets without placing his principal at risk, there is the option of principal protected notes. Oh, just the vibe? Yeah. If that's what you hear, then totally. It's open to interpretation. Sandra explains to Paul that principal protected notes provide investors with principal guarantee on their original investment. The investor's return consists of a percentage of the market's index return over a preset time frame. So that is like a market-linked GIC or an index-linked GIC. Principal protected note. They explain it basically right there. Sandra suggests to Paul that a 3-year ABC Bank Canadian Equity Growth PPN would be an ideal fit. PPN's 3-year term allows Paul to learn about how this solution can work to help him reach his goals while not locking him into a longer term. ABC Bank is a top Canadian chartered bank. There is essentially zero issuer credit risk. Paul's principal is guaranteed. The return is linked to the S&P TSX Composite Index return over the 3-year period. So Paul will participate in the upside of the market's performance while avoiding any downside. However, Sandra explains that the cost of the guarantee is that Paul will receive only 50% of the index's return at the conclusion of the 3-year term, and that if the return is negative, he will receive his principal back, but a nil return. Paul is willing to accept this cost, even given his desire to find the right balance between risk and reward that probably fits his needs. And then what are hedge funds? We'll finish off with hedge funds and then we'll call it there. And then we're on 13-7. Not bad, Mindset Fam. Not bad. And Nana, you've been studying with me for like the full half hour at least, or longer. That's awesome. And this will give you a good idea of whether you want to get into banking or not. Because this is how you start. You start with mutual funds. What are hedge funds? Hedge funds are lightly regulated pools of capital whose managers have greater flexibility in their investment strategies. Hedge fund strategies are often referred to as alternative investment strategies. Hedge fund managers are not constrained by the rules that apply to mutual funds. The managers can take short positions, use derivatives for leverage and speculation, perform arbitrage transactions, interesting, and invest in almost any situation in any market where they see an opportunity to achieve positive returns. In addition to alternative strategies, the category of alternative investments includes alternative assets and private equity. These investments include, but are not limited to, real estate, commodities, and investments in securities that are not publicly listed. Despite the hedge fund name, some funds do not hedge their positions at all. It is best to think of a hedge fund as a type of fund structure rather than a particular investment strategy. Another type of fund structure that utilizes alternative strategies is the alternative mutual fund, otherwise known as liquid alternatives or simply as liquid alts. This type of fund was recently introduced to Canada, replacing what were known as commodity pools. By regulation, alternative mutual funds are allowed greater use of short sales, leverage, and derivatives compared to mutual funds, but not the same extent as hedge funds. Unlike hedge funds, alternative mutual funds can be sold to retail investors. Did you have? Yes, I had to pay for this course. Yeah. Normally, if you're already working at the bank and they want you to get your mutual funds, once you're in the bank, they pay for it. But if you're not in the bank and you're trying to get back into the bank, they now it's now required before you can for certain positions. Yeah. But as long as you get into the bank and then you work your way up, you can also get it paid for by the bank. By regulation, alternative mutual funds are allowed greater use of short sales, leverage, and derivatives compared to mutual funds, but not the same extent as hedge funds. Unlike hedge funds, alternative mutual funds can be sold to retail investors. Hedge funds, in contrast, have a more limited audience. Okay. Oh, interesting. So it says mutual fund representatives are not allowed to distribute alternative mutual funds unless they possess one of the following: passing grade for the Canadian Securities course, passing grade for the Derivatives Fundamentals course, successful completion of the Chartered Financial Analyst program, or any applicable proficiency standard mandated by a self-regulatory agency. So you need definitely a few courses to be able to sell these, which I don't have yet. So if that's something that I did want to sell, I'd have to upgrade my licensing and get additional courses to be able to sell that. Hedge funds or alternative mutual funds. Because hedge fund managers have tremendous flexibility in the types of strategies they employ, the manager's skill is more important than for other alternative managed products. Additionally, a hedge fund's investment objectives and investor suitability vary depending on the manager's choice of strategy and the targeted risk return level. Let's leave it there. So you can work, you can sell. So you can. It says if you've passed the Canadian Securities course, the Derivatives Fundamentals course, or the Chartered Financial Analyst program. Yeah, as long as you've met the proficiency standards, it says. But yeah, we're leaving the blank mindset fam. 13-7. Not bad. Shush pop. Right. Oh wow, it's quite the howl. There. All right. It's 8. Oh, almost a 99-minute stream. But we'll try and do some more studying later as well. As long as I can get something. Pino, shush. All right. I gotta go. You need to go potty, Pop? I gotta go. I gotta go. He's going crazy. Maybe happy, maybe healthy, maybe at peace. Thanks for tuning to the Stream Mindset fam. And if you haven't already subscribed, hit that subscribe button. I will try and go live later today. Yeah, he's such a cute dog. I'll try and go live later to another study session if I have energy. But yeah, we already meditated and we studied. So productive morning. And we're fasting till lunch. Ciao. I will see you guys at lunch. Probably, I'm gonna say, yeah, 12 p.m. So I'll be home by 12:15 or